Hey everyone, welcome back to the channel. Today we're going to do a quick DCF on Palantir. Show you real quick. Pulled in a lot of the historical financials already. I'll show you real quick where you get those from. So we head on over to sec.gov. Top right, you'll do more search options. You can go ahead and type in Palantir right there. And the first file we pulled from is their last S1, so the S1-A. A stands for amended. They'll usually file an amended version right before the public offering with kind of the complete information included. And if we scroll down here, you'll see consolidated financial data down here. So this will be the income statement, and then they'll have the balance sheet as well at a very high level. And then if you actually kind of scroll through here on page 119, they have the cash flow statement. So we'll scroll down just to show you that real quick. And for this, it's once again at a pretty high level. Um, you'll see it's just operating, investing, and financing, but they actually have commentary that'll walk you back to all of these so you can kind of pull out the PP&E and the D&A out of those numbers. So that's the first place I pulled a lot of this financial data, and then the second place is just their most recent 10Q. If you go in here, you'll see they have balance sheet, income statement, and then a cash flow statement down here as well. So they will have everything in here. So now that you kind of understand where this data pulls from, we'll kind of get working here. And the first thing we really need to do is forecast out Q4 of 2020. And I'm going to do it in a pretty simple method. I'm just going to keep it as a percentage of, so whatever the Q4 percentage of 2019 was, we'll do that. We'll hold that same percentage true for Q4 of 20. The formula for this, it's going to be the sum of Q1 through Q3 divided by 1 minus the percentage that we want for Q4, and then we have to subtract out the sum of Q1 to Q3. You'll see that gets you this 344 right here. And then I did a check here just to divide that to make sure that those percentages tie. So we'll go ahead and we'll copy this formula down, and we'll see if anything's looking really wonky. And the first thing I'm noticing is this one looks very wonky. And that's because it's a bunch of negative numbers. So maybe if we, I'm not going to spin my wheels trying to recreate that formula, to be honest. I'm just going to, we're just going to put this as a placeholder at like negative 4,500. It's a pretty small number anyways. So anyways, then we'll have a Q4 number here, which is kind of the first step we need for forecasting this out. And then we can actually we'll sum up a 2020 number here that we can link back to our model, which will be important when we're making the forecast. So this is kind of the first step here is you really just have to forecast out when you're using quarterly data. You have to forecast out that full year. And then once you have the full year, then we can link up our model and make everything work. So it's really the first step here. That's a pretty big loss for 2020. That's crazy. I guess Q3 they had a massive loss. If we look at that, I mean, yeah, that's just their costs right there. I mean, that's almost the same as the full year historically, and they had that in Q3 for their OPEX. But we'll link this up and we'll see kind of what we can get. They do provide historical revenue in their S1, so I'll link that up. And let me actually just times this by 1,000. I believe. And actually, these two I'll link up somewhere else. But yeah, that one was on kind of different formatting. And then for 2018, and then we'll have 2019 as well. And then those two can just copy down for COGS. SG&A is really just going to be the OPEX here. Let's see, we'll just kind of high level quick, make sure those things are tying. We'll see negative 623 and negative 576. Yep. D&A, we do have, I believe, on the cash flow. There's D&A. And we got to multiply that by 1,000 just because not everything was consistent across all their filings. Let's just make sure that's right. 12.3, cool. And then There's one other thing I think we're going to have to really, that's, yeah, I mean, the tax affected EBIT is going to be a little wonky on a company that's operating at a loss. Um, Normally, this is kind of take out the impact of cash taxes, but they're not going to have any clearly because they're operating at a loss. I don't believe. Do they have anything on their income statement? They have a provision for taxes. I may actually just use this over this hard-coded formula because that's given some wonky stuff there. So for 2018, just link that up. Actually, that one needs to be deleted. And then we're going to add one more line into our model here. We're going to add back stock-based compensation. This is a huge line item. If we look at their, they call it out on the cash flow statement. I mean, 9 months ended for 2020. It's already $1 billion. It's a non-cash expense in a way. Obviously, it's going to be hurting the investors, but it is something that should definitely be added back here when we're trying to get a free cash flow. And then for 2020, we pro forma'd that out, so we'll just come grab our 2020 numbers. That should actually be SG&A. We got it 2 billion, and then D&A. I think on cash flow we have a 9 months ended. I'm just going to use this as a proxy. I mean, it's such a small number for them. It doesn't look like this is a very capex intensive business, so. And then we'll have to calculate the tax rate instead of just doing this like placeholder since they're not operating at a profit. We'll just divide that by revenues. Yeah, I mean, it's tiny, so we'll just hold this to 1.7. And that's obviously, if they ever become profitable, would change, but for now. And then, so now for stock-based comp, we'll link this up. It's 2018. Kind of multiply that by 1,000 once again. Sorry about the placeholders not being all the same. Link up 2019, multiply that by 1,000. And then for 2020, I mean, we could, I mean, if we look at first half, they're at 182, 2019, 242, 248, and then they jump up to $1 billion. I'm going to assume they're not going to issue a lot more after this IPO, so I'm just going to leave that for now. You could probably tweak this up another 100 million, 50 million, something like that, but it's not going to be anything super material, I wouldn't imagine. And then PP&E, do that, multiply by 1,000. Copy that over. And then this one will link up as well. 7.5. It looks like they've been trending at 13. I'm actually just I'm gonna hold that for now. And then working capital is the last thing we need to throw in here. So I actually do calculate this on the balance sheet. We have 2019 numbers. So let me just drop those in. I screwed up my formulas there. Let me do that. And then for 178, and then we have 9 months ended, so we'll just stick with that. And then we can look at, I mean, those are actually some pretty massive swings. Let's take a look what's happening there. Is this, yeah. And we should actually be able to calculate 2018 as well. Oh no, because this is their, yeah, no, they didn't break it out. So this is actually just from the most recent 10Q. So we don't actually have 18, but we can see prepaid shoots up, AR shoots up, and then liabilities basically stay flat. So from that stance, yeah, it is pretty crazy net working capital there. We'll reverse that out. We'll have current assets kind of reverse down and liabilities go up. We're going to assume as they become more a larger company that they can start to kind of leverage their ability to extend credit when they're buying and then pressure people to so they can buy quicker, but or pay have customers pay them quicker and they can extend their credit to pay slower to make it kind of a positive to their cash flow. So now we'll forecast out, I guess, some of their financials. And if we look at their historical revenue, it's actually been growing at a pretty good clip here, right? Like, I mean, it's been growing pretty well. So I don't think it's unrealistic to take maybe this and scale it back 5% a year until you get into the 20s. I mean, actually 10 years from now, maybe they just reverse down to being a mid-single digit company in growth. COGS looks like it's slowly been increasing. That's something that they're gonna hopefully steady out with. So we're gonna leave that constant for now, and we'll see how that brings out our model. Yeah, help if I linked everything as well. There we go. SG&A, this clearly has to change. I mean, that's going to be mostly stock-based compensation, but you can't, I mean, are they going to turn it around next year? Probably not. So we'll give them 2 years to have SG&A decrease and then kind of align to probably something that's more normal. Or we'll just decrease it 10% a year until they get, I mean, even 50% is crazy SG&A. I don't know how hard it is going to be for them to actually scale this stuff back, and we'll leave it at 30. 30 might even be aggressive. I'm trying to think of some other models that I've done and where SG&A floats. But we'll see. I mean, these are highly paid and compensated individuals, so this is definitely an assumption we could go back and tweak and something that we should probably align with other tech companies and see how they kind of trend over the years. Link these up. Then we can see how CapEx is trending, about 1 to 2%. I'm just going to leave it at this and then I'll just leave it close to 2%. I think that seems reasonable. So then when we calculate this, let's just be a formula. We'll actually drop a negative in there. That'll give us our CapEx amount. Depreciation, I'm going to set this at like negative 0.9. I'm going to assume they have to have some growth CapEx in there. It's not going to just all be maintenance CapEx, so CapEx should be growing faster than depreciation. But then we can link that back up. And then, so like I said, we're going to have this actually decrease over time and kind of reverse to the mean. We'll leave it at like, I think 20% is actually probably pretty reasonable from just kind of some past things I've looked at, and we'll have this kind of go up until like, I don't know, leave it at like 23. That way their net working capital then becomes a good thing for them instead of a bad thing. So now we're going to link up all the formulas here. And this is where it kind of gets fun. You get to see, is Palantir ever going to be profitable? So, I mean, yeah, they're growing from $1 billion. I mean, growing $1 billion at 45%, that might be a hard clip to scale, but I guess we're going to be pretty bullish on this and just kind of see how things play out. COGS, because I mean, right now they're incredibly unprofitable, so they're going to have to do something to kind of turn everything around. SG&A, this is a fun one because their SG&A is absurd. But I mean, a lot of that is stock-based, and that is something that we actually don't have forecasted in here yet. So we're going to have to try to figure out a way to forecast the stock-based compensation, D&A. We're just going to link up down below. So it was averaging about 250. I'm actually going to set it here, and I'm going to go with 25. I'm going to go with like, oh, I forgot this is all formatted funky. There we go. And then I'm just going to add 5 a year. As the company grows, they're still going to have to retain talent. They're still going to have to pay stock-based comp, but not nearly the same as what they paid this year. And then here, we just want to actually flip those signs. Actually, no, those should be negatives. I need to do the same here. Just the way the formula is set up. There we go. And then change in net working capital, you can see it kind of slowly becomes more in their favor. Interesting. So maybe I'll actually, you know, that I think that's fine for now. We can leave that for now, and we can come over here now and actually see what kind of valuation these wonky numbers give us. Let's do a 10% cost of capital. Based off that, we're saying 3.5 billion for their cash flows, 3% perpetuity, terminal value, present value that, enterprise value is 17 billion, net debt. Let's see how much debt they have, if they provided that to us. Debt, plus we're going to do preferred, redeemable, plus warrants. I think that can all be kind of converted, but then we got to subtract out cash. Then we actually want to subtract that. So we're say equity value, 18 billion. I mean, honestly, I'm not sure where they're trading. Let's go to Yahoo, take a look. And that's space, different meme stock for a different day. They're trading at 51 billion. Okay, so we're pretty far off. We're pretty aggressive here. I mean, we can look at our sensitivity table here, right? If you only need an 8% return here, let's drop this down to 5. Then we'll get probably something in the range. So if you're comfortable with a 6 to 7% return, assuming a 3 to 4% perpetuity growth after 10 years, you get somewhere in that ballpark. And I mean, this is with heavy SG&A cuts, right? We're assuming that this decreases at a pretty healthy clip, and who knows, they could do that sooner. They could cut stock-based compensation tomorrow and probably get rid of a lot of their sales and marketing costs. We're assuming it's going to be CapEx light overall. Assuming net working capital is going to kind of slightly change to their favor. I think the big assumption here is that revenue growth, right? Are you really going to be able to grow? Like, sure, in 2020, it looks like they're on pace to grow 50%. But I guess once you kind of saturate the government markets, are you going to be able to continue these 45, 35, 30% growth rates? I don't know. I think it seems a little overvalued. And I mean, if we just look at this from the last month, right? trading at 15 a share, so half the market cap. You're closer to 25 billion, right? And they IPO'd at 10 a share, so almost a third of this market cap. Probably 18 billion was probably closer to the IPO. Yeah, I mean at 18 billion, I mean, yeah, you can make these super aggressive assumptions. You could scale these back even, right? You could probably drop this 10%. Yeah, and you're still getting more than you need. Um, so yeah, definitely interesting. You could scale back the growth much quicker and still get kind of in that $18 billion range. So yeah, definitely. Um, it's an interesting company. It'll be interesting to see how Q4 plays out for them and to see if they come under any kind of regulatory pressure or scrutiny, especially as they're signing contracts with other governments and their US-based entity is the US government, is the Biden administration, things of that nature are going to be trying to crack down on this or allowed to keep going. But yeah, I mean, quick analysis shows, if they can keep that very strong growth, definitely a good company that's probably valued. They're definitely valued for high growth as is. Anything higher than this, right? I mean, you're gonna have to be saying they're growing 50% a year, just to even get something remotely what you're looking for, right? We're saying if they can grow 50% for the next 2 years and then decrease 5% a year for 8 years in a row after that, then they're probably, I mean, they're still overvalued if you need a 10% whack. And historically, the S&P is around a 10% return. And then obviously when you adjust for inflation, it's about a 7%. So with that, I mean, you're you'd be assuming pretty strong growth for the next 3 or 4 years from them to get to the current valuation, which is, yeah, I mean, you got to have 50% growth for 4 years. So yeah, definitely they're valued for growth for sure right now, but something we're probably keep an eye on and see how they trend and if they can keep the growth up and the price can kind of settle down a little bit, who knows? Could be an interesting company to keep your eye on. Hope you found this useful. If you have any questions at all, feel free to leave them in the comments below and I'll get back to you. Thanks so much.